Now the question from Zubin today is, should I do a principal and interest loan or an interest-only loan? So that's the first part to the question, and this is the part that I've probably answered previously, but simply, I might just explain the differences first. So interest-only loan, you are only paying back the interest repayments only. $400,000 property, 5% interest per annum. As an example, it's an expensive interest rate these days, but back in my day when I was investing, it was quite cheap. What's that? $20,000 a year in interest. You divide that by 52 weeks. That is what you pay the banks. Nothing more, nothing less. It's a pretty simple calculation. You're only paying the interest associated with that loan. Obviously, it's not paying the principal down. It's not paying your $400,000 loan amount down. And you might think, well, why would you do that? Well, put simply, it preserves your cash flow. Instead of paying the interest plus paying down the principal, so two components to your repayments each week, you are only paying the interest, so you have more cash flow. Cash flow is king, right? It's your servicing, it's your ability to borrow more money to continue investing in the future. Preserving that cash flow is critical to scaling out a portfolio. You might think, well, hang on, that's risky. Well, what happens? I want to pay that loan down. I want to generate equity in that property. And I can probably come back to that in a moment, but there are plenty of ways of skinning a cat. So, if that's clear to everyone, the differences firstly between interest only and principal and interest, I'll jump into which one. Now, think of the reasons why people might generally prefer principal and interest. And probably the most common reason that I hear in talking to investors is, I like to have a buffer. I like to have a comfort zone. I like the idea that I'm buying this investment property, it's paying itself off, and I'm building equity in that property through paying down the loan against it. And eventually one day, maybe in 30 years, maybe sooner, we don't have a loan on it and you own that property unencumbered. Hip, hip, hooray. That's excellent. That's a great comfort zone. It's a nice, warm, fuzzy feeling. In reality though, we're not holding properties with the one loan very often for 30 years. The average loan refinance period in Australia is around 3 to 4 years. I don't know exactly, but last time I heard it was 3 to 4 years. You think about that, on average, people are changing loans every 3 to 4 years. We're not really getting towards ever paying a loan off on a property very often. And why would you? The interest repayments are generally tax deductible. The principal repayments are not. Okay, so if we are preserving our cash flow, we're only paying down principal, or only paying our cash flow towards interest. That means potentially we can preserve that cash flow, buy other properties, and then have a higher total interest repayment, which is very tax effective. That means we're potentially, instead of buying two properties, we might be able to afford a third. We've then got capital appreciation on a larger asset base, and we're well and truly ahead of the pack if that's the case. We've got capital gains on a third property which we otherwise might not have had. That really does get us out ahead of potentially paying down the principal. So the warm fuzzy feeling when you look at the cold hard numbers, if you are paying your your incomes, your wage off the principal of these investment properties, you're going to get stuck in the mud very quickly. Now, how do we get around that warm fuzzy feeling? The perceived advantage of the principal and interest loan, we're paying down the principal. Well, you can do the same thing effectively with an interest-only loan. Okay, you just don't have to give it to the bank. You can put that surplus principal payment, if your interest repayment is $300 a week and your principal repayment or paying down is say $100 a week, well, you can still keep paying the $400 a week. You just put the $100 into an offset facility against the interest-only loan amount. If that loan product doesn't have an offset facility, you can just put it into a savings account and just leave it as a rainy day fund. So you are still building that buffer. It's just from the bank's perspective, it's not something that is required every week. So when they assess your serviceability, they are not looking at the principal as something that you have to pay each and every week. Therefore, you're preserving your cash flow. You have smaller obligations each week. You can afford a larger amount of loans, compared to your overall cash flow. Does that make sense in terms of the differences? So for me, I think Zubin is actually a moot point. The perceived advantages of principal and interest are not in fact actual advantages, because you can recreate a principal and interest type scenario with an interest only facility by paying down the principal as well. You can stop doing that in the future. You can divert it into another investment. You can, if you wanted to, and you're comfortable, spend it on an overseas holiday or whatever it might have been. This is not obviously advice, but it is there as a rainy day fund. There are a few considerations though. Okay, sometimes you're not able to access the same interest rate. All right, so sometimes an interest-only loan might be slightly more expensive. It sometimes might have different fees, different entry and exit requirements. So you do have to weigh up the advantages and disadvantages. If you weren't planning on buying any further investment properties, you don't need to preserve your cash flow, your serviceability, then you might consider the principal interest type loan. You've got to look at the tax savings as well, the tax implications, but there may be scenarios where you'll consider it because the interest rate is slightly lower, but very rare cases. 9 times out of 10, interest only wins out. For me personally, I always employ interest-only loans where possible. For me, preserving that serviceability is always a priority. It's, for the vast majority of Australians, the reason why they're not buying more properties is not really because of the equity. We've just gone through a great period of capital gains. We've got equity sitting in our properties. Most people can't buy further properties because they can't service any further debt. Okay, so preserving cash flow is king. You never know when you need that serviceability.